Welcome to another episode of The Wealth Effect. I'm your host, Green Moon, and today we're diving into a subject that separates those who succeed from those who only dream: risk tolerance. The two words that determine how you handle uncertainty, how you react to financial opportunity, and ultimately how you build wealth. Every person has different levels of comfort with risk. Understanding your own tolerance can be the difference between financial success and sleepless nights filled with anxiety. Risk is the price we pay for opportunity, and whether we like it or not, every decision we make, big or small, involves some level of risk. But here's the problem. Most people don't understand their own risk tolerance. They either take on too much, losing everything in the process, or they take on too little and never build real wealth. Today we will discuss and explore what risk tolerance really is, how to determine your own, and how to use it effectively to build a strong financial future. Because risk is a part of life, and the key is to learn how to manage it and not avoid it. Section 1. What is risk tolerance? Let's start with the basics. What is risk tolerance? Risk tolerance is your ability to handle uncertainty. It's how well you can sleep at night, knowing that your investments, your businesses, or even your job could go south. It's emotional, it's psychological, and it's personal. It's your ability to handle uncertainty and volatility without losing your mind. If you grew up in a household where money was scarce, you may have developed an aversion to risk. If you've always had a financial cushion, you might be more comfortable with more risk. But here's the truth. Your past doesn't have to dictate your future. Think of it this way. Some people can skydive for fun. Others break into a sweat just stepping onto an escalator. That's risk tolerance in action. And when it comes to money, understanding your risk tolerance is crucial, because the last thing you want to do is put yourself in a situation where you're either paralyzed by fear or reckless beyond reason. Section 2. Understanding risk tolerance. Risk tolerance isn't just about numbers on a screen. It's a reflection of who you are, how you think, and what you value. It's the psychological and financial threshold that determines how much uncertainty you can endure before fear takes over. And understanding it is crucial because risk, like change, is inevitable. The 3 pillars of risk tolerance. Your risk tolerance is shaped by 3 key factors, each one a lens through which you view opportunity and danger. The first one, emotional risk tolerance. The Stoics thought that fear is often worse than the thing we fear itself. The same applies to investing. When the markets plunge, when an investment underperforms, or when unexpected expenses arise, do you panic? Do you sell everything in a moment of doubt? Or do you stand your ground, remembering that volatility is a price of admission for wealth building? Some people can sleep soundly despite financial uncertainty. Others are paralyzed by the mere thought of loss. This isn't just about discipline, it's about self-awareness. Understanding your emotional response to risk is key, because no amount of financial knowledge can override fear if you let it control you. The second one, financial risk capacity. Risk tolerance isn't just about how much you think you can handle. It's about what your financial reality allows. A billionaire can afford to take a multi-million-dollar gamble and recover. But for someone living paycheck to paycheck, that same gamble can be catastrophic. You have to know your financial foundation. Are you carrying high interest debt? Do you have an emergency fund? Are your basic needs secured? If the answer is no, your capacity for risk is lower, not because you lack courage, but because wisdom demands that you protect your foundation first. Financial security gives you the privilege to take risk, while financial instability makes risk reckless. The third one, experiential risk perspective. Your past experiences with risk create the lens through which you view it today. If you grew up watching your parents struggle after a failed business, you might be more risk averse. If you once invested and lost a substantial amount, you might hesitate before taking another leap. Conversely, if you've seen risk pay off, If you took a chance on a new job, a new investment, or a new skill and it changed your life, you might be more willing to embrace uncertainty. But here's the thing, the past should inform you and not define you. Epictetus taught that we should judge situations not based on past fears, but present wisdom. The mistake many people make is allowing past failures to create a permanent hesitation towards risk. Every investor, entrepreneur, and successful individual has encountered failure. What separates them is their ability to learn, adjust, and try again, wiser this time. Section 3. Discovering your risk profile. Risk tolerance is personal. It's not something you copy from a financial guru, a friend, or even a mentor. It's something you must uncover within yourself. Because at the end of the day, the best financial strategy in the world won't help if it doesn't align with your nature, your reality, or your goals. So how do you find your personal risk profile? You ask the right questions. And more importantly, you answer them with honesty. The first question, how do I react to uncertainty? Picture this. The market takes a nosedive. Your portfolio loses 20% in a matter of weeks or days. Headlines scream doomsday predictions. What's your instinctive reaction? Do you feel the urge to sell, to cut your losses before they get worse? Or do you recognize that volatility is temporary and stay the course? Your answer here tells you a lot because risk tolerance isn't tested in times of prosperity. Is tested in times of chaos. We must prepare for the storms before they come. If uncertainty unnerves you, that's not a flaw, that's information. It means that you need to be more conservative in your investment strategy, or you may need to train yourself to better handle financial turbulence. What is my financial capacity for risk? This is where philosophy meets reality. You might be emotionally comfortable with risk, but if a single bad investment could wipe you out, then you're not really playing the game, you're gambling. Ask yourself, if an investment went south, could I recover? Do I have an emergency fund? Am I risking money I need or money I can afford to grow? Taking risk beyond your capacity isn't bravery, it's reckless. A solid financial foundation lets you take risks without losing everything if things don't go to plan. What are your long-term goals? You can't assess risk without knowing what you're aiming for. A day trader's risk profile is completely different than someone who's investing for retirement. Are you playing a short or long game? If you're looking for quick wins, you may tolerate higher risks, but must also accept the higher volatility. If your goal is wealth accumulation over decades, consistency will matter more than chasing high-risk opportunities. This is why clarity is power. If you don't know where you're going, how can you possibly choose the right path? Define your goals and your risk tolerance will be much clearer. How do I handle loss? Loss is part of the journey. There is no way around it. The only question is, how will you respond to it? Does a financial setback feel like a personal failure? Or do you see it as a lesson, a cost of doing business? History is full of people who lost fortunes only to rebuild them stronger. The difference between those who succeed and those who don't isn't that they avoided loss, it's that they didn't let the loss define them. If you treat every loss as a catastrophe, you'll hesitate when opportunity presents itself. But if you see loss as a part of a learning curve, you'll stay in the game long enough to win. Section 4. Types of risk tolerance. Risk tolerance isn't a one-size-fits-all concept. It exists on a spectrum shaped by experience, mindset, and financial situations. Some people thrive on uncertainty. Others break into a cold sweat on the thought of losing $1. Neither is inherently right or wrong, but knowing where you fall on the spectrum is essential for making smarter financial choices. Risk-averse individuals, the cautious planners. These are people who play it safe. They like stability, predictability, and low volatility. Their financial strategy often revolves around steady paychecks, saving accounts, bonds, and minimal surprises. This approach is not wrong. It's just slow. If you prefer a conservative path, you might avoid catastrophic losses, but you might also limit your potential upside. Warren Buffett famously said, "The stock market is a device for transferring money from the impatient to the patient." However, even patient requires a willingness to take some risk. If you recognize yourself in this category, ask yourself, am I avoiding risk entirely or am I managing it wisely? Because playing it too safe can be just as dangerous as taking on too much risk. Inflation erodes savings. Missed opportunities can cost you more in the long run than a well-calculated risk ever would. Moderate risk takers, the calculated strategist. This is where most successful investors and entrepreneurs live. These individuals take calculated risk, they do their research, plan ahead, and they are willing to take a chance whenever the odds are in their favor. A moderate risk taker understands that no investment is without risk, but they also know that avoiding risk entirely is a losing strategy. They diversify their portfolio, hedge their bets, and position themselves to recover from setbacks. Think of this group as the generals of their own financial battlefield. They don't charge into war without a plan, but they also know that sitting around in the trenches forever will never win them the war. They take action, but with strategy and not recklessness. Aggressive risk takers, the high rollers. Then we have the high stakes players. These are the ones that put everything on the line for a big payout. They chase aggressive investments. They take bold entrepreneurial leaps and often embrace a high risk, high reward mindset. This strategy can lead to immense success if it's backed by skill, preparation, and a plan for when things don't go as expected. But if it's driven by impulse, ego, or the illusion that every bet will pay off, it becomes dangerous. If you're in this category, ask yourself, do I have a plan for failure? Because the difference between a calculated risk taker and a reckless gambler is preparation. If you can absorb losses, adjust your strategy, and keep playing, you might succeed. If you're betting your entire future on a single move, you might want to think twice. Section 5. Expanding your risk tolerance. Most of what we avoid isn't dangerous, it's just unfamiliar. Risk is no different. It's not inherently bad or good, it's just a force. But here's the paradox. If you're too risk adverse, you'll never grow. If you're too aggressive, you'll eventually collapse. The key is to find balance, to stretch your tolerance for risk without snapping. How do you do that? You train yourself. Like a muscle, first, start small. Train yourself for discomfort. The only way to become more comfortable with risk is to expose yourself to it in increments over time. If you never invested before, start with a small amount. Feel the emotional weight of your money being in motion. If you're terrified of entrepreneurship, don't quit your job tomorrow. Start a side hustle, something small and manageable. Get used to making money outside of a paycheck. If you freeze at financial uncertainty, set small changes. Skip a month of unnecessary expenses and invest the difference. Get used to calculated exposure. In other words, lift what you can, then increase the weight. Risk tolerance isn't an inherent trait. It's something you build. The more you do it, the more normal it becomes. What once seemed terrifying becomes second nature. 2. Educate yourself. Risk is less scary when you understand it. Fear often comes from ignorance. When you don't understand something, it feels bigger than it really is. But when you study it, break it down, make it familiar, its power over you fades. Read history. How markets move, how people rise and fall, how risk rewards those who understand it. Study investors, entrepreneurs, and visionaries, not just their success, but how they handled failure. Learn about possibility and decision making. Because risk isn't just about numbers, it's about how we respond to uncertainty. The more you study risk, the less it feels like luck, and the more it feels like strategy. 3. Master your emotions. Because fear and greed ruin fortunes. Risk tolerance isn't about numbers, it's about psychology. When it comes to market crashes, do you panic and sell? When an investment skyrockets, do you get greedy and hold too long? When you take a hit, do you freeze or do you adjust and move forward? The people who succeed aren't fearless, they're disciplined. They don't let fear push them away from opportunity, and they don't let greed blind them to reality. The best way to train for this is start small, controlled exposures to risk. The more you see, the less you react. The less you react, the better decisions you will make. 4. Have a safety net, because risk without a plan is just reckless. Risk tolerance isn't about recklessness. It's about making bets you can afford to lose. Do you have an emergency fund? If not, your risk tolerance isn't real. It's just borrowed time. Is your income diversified? If all your money comes from one single source, you're more exposed than you think you are. Are you over leveraged? Debt magnifies risk. Make sure your foundation is solid before you take big swings. A safety net doesn't eliminate risk, but it can change the way you take risk. It lets you be bold without being reckless. It allows you to play the game for the long haul. We don't avoid hardship, we lead into it. Risk is no different. If you train for it, if you embrace it, if you master it, it stops being a threat and starts being an opportunity. Section 6. The relationship between risk and reward. Risk is the toll we pay on the road to success. If you want more, if you want to build something meaningful, wealth, impact, legacy, you will have to take risk. The question is, will they be calculated or careless? Risk and reward are directly connected because that doesn't mean risk is inherently good. It's not about taking risk. It's about taking the right risk. Not all risk is created equal. There's a misconception that high risk automatically leads to high reward. That's not how it works. Some risks lead to ruin, some lead to wealth. The difference is your approach. Let's break it down. Low risk investments include savings accounts, government bonds, and stable real estate. They won't make you rich, but they provide stability. Think of these as your financial foundation, solid ground to stand on. Moderate risk investments, dividend-paying stocks, index funds, well-researched businesses. This is where steady, long-term wealth is built. Warren Buffett calls it get-rich-slow approach. It's not flashy, but it works. High-risk investments. These are startups, cryptocurrencies, and speculative real estate. Some people will make millions, and others will lose everything. If you're going to play here, you better know what you're doing. The key is balance. Risk too little and you'll never grow. Risk too much and you might never recover. Taking risk isn't brave. Being prepared is brave. The best investors, entrepreneurs, and decision makers don't fear risk because they plan for it. Experience makes risk easier. The first time you take a financial risk is terrifying. You overthink it, you hesitate, you might feel like an imposter. But the 10th time, you're sharper. You trust yourself more, and you recognize patterns. That's because experience transforms uncertainty into intuition. The more time you spend making decisions, the better you get at making them. The best risk takers aren't lucky, they're just seasoned. They've seen enough to know when to act and when to wait. Section 7. Why people fear risk. Risk is not the enemy. Fear of risk is. Most people fear risk not because it's dangerous, but because they don't understand it. They treat it as something to avoid, something that could wreck their lives. But the truth is, risk is woven into everything. The real danger isn't risk itself, it's how we react to it. It turns manageable challenges into insurmountable ones. It makes us seem like failures before we've even started. But if you can master your mindset around risk, you can unlock opportunities that others will never see. The illusion of security. Most people avoid risk because they think it makes them safe. But what they don't realize is that playing it too safe can be the riskiest move of all. Inflation silently eats away at the money left in your savings account. Jobs that once felt secure can disappear overnight. Entire industries shift, leaving those unwilling to adapt behind. The world is always moving. If you refuse to take risks, you're not actually avoiding danger. You're just standing still while everything else around you changes. Security is an illusion. The only real safety comes from your ability to adapt. Why we fear losing more than we love winning. Our brains are wired to fear loss. In psychology, this is called loss aversion. The idea that losing $100 hurts far more than gaining $100 feels like. This is why so many people panic when the stock market drops. Instead of seeing a downturn as temporary, they see it as a catastrophe. They sell their investments at a loss. They lock in their failure instead of waiting for a recovery. They forget that the markets move in cycles. They forget that short-term losses mean nothing in the long-term game. They forget that staying calm is a competitive advantage. The best investors and entrepreneurs aren't immune to fear. They've just learned to not let it control them. They understand that risk isn't something to run from, it's something to manage. Overconfidence versus paralysis. The two deadly extremes. Fear of risk leads people into two dangerous directions. Overconfidence. Some people believe they can't fail. They take reckless risk, betting everything without a plan. When things go wrong, they're caught completely off guard and could lose everything. On the other hand, there's paralysis. Paralysis are people so afraid of making a mistake that they never take action at all. They wait for the perfect opportunity that never comes. Their fear of failure ensures that they will never succeed. Both of these sides are traps. The first leads to disaster and the second leads to regret. The answer lies in the middle. Taking smart risk, preparing for setbacks, and always keeping a long-term perspective. How to master your psychology around risk. If you want to improve your relationship with risk, start by shifting your mindset. Risk is not a threat, it's an opportunity. Every successful person took a risk to get where they are. Failure is not fatal. The greatest lessons come from mistakes you survive. Fear is not a stop sign, it's a signal. It means you're stepping outside of your comfort zone, and that's where growth happens. The world belongs to those willing to take calculated risk, not the reckless, not the timid, but those who understand risk, embrace it, and use it to their advantage. Because in the end, risk isn't what holds most people back. Fear is. Finding confidence in your own risk tolerance. The ultimate goal isn't taking risk blindly. It's to develop deep sense of financial confidence. The ultimate goal isn't to take financial risk blindly. It's to develop a deep sense of financial confidence. Confidence that comes from knowing your own limits, making well-informed decisions, and understanding that risk is simply part of the process. Risk tolerance isn't about being fearless. It's about understanding what you can handle, stretching your limits strategically, and using risk as a tool to grow. Those who master this mindset achieve financial independence, not because they never take risks, but because they take the right risk at the right time. So take some time to reflect, find your own risk tolerance, develop a strategy that aligns with your personality and goals. And most importantly, take action, because in the end, the biggest risk of all is doing nothing. Reckless people lose everything. Fearful people gain nothing. The winners are those who understand risk, manage it, and use it properly. You could lose your job. You could lose your investments. You could lose everything. But the real loss, that comes from letting fear keep you small. That comes from never making a move. That comes from waiting for certainty in a world where certainty doesn't exist. That's it for today's episode on the Wealth Effect. If you got some value out of this episode, share it with someone. And remember, wealth isn't just about money. It's about mindset, strategy, and the courage to take action. Until next time.